Welcome to Part B of All About Economics. We now leave the whole economy behind and step into the world of finance and securities, the markets where money is invested, risked, and grown. And it begins with the single trade-off that governs everything in investing. The chance to make money always comes with the risk of losing it. In this opening finance episode, you will learn what investment risk really means, how to discover your own relationship with it, why a 7% return might secretly be a terrible result, and the powerful idea that earned a Nobel Prize, that by combining assets cleverly you can lower your risk without giving up return. This is the foundation of all modern investing. Let us begin. Section 1. The fundamental trade-off. Here is the iron law of investing. Return and risk are joined at the hip. We all want our money to grow, but the very moment you reach for a higher return, you take on a greater chance of loss. There is no investment that offers high returns with no risk, and anyone who promises one is selling a fantasy or a fraud. A government bond is safe but pays little. A speculative stock might double or might collapse. This trade-off is not a flaw in the system to be escaped. It is the system. Every sensible investment decision is really a decision about how much risk you are willing to bear in pursuit of how much return. Understanding that balance is the whole game. Section 2. What risk really means. So what is investment risk exactly? When most people hear the words, one idea pops into their heads: losing money, the risk to the capital you worked so hard to build. That gut feeling is the right starting point. But economists sharpen it into something measurable. Financial risk is really about uncertainty, the spread of possible outcomes around what you expect. An investment whose value could swing wildly up or down is risky. Even in a year it happens to go up, because the outcome was far from certain. We measure this spread with volatility, often the statistical standard deviation of returns. The wider the range of things that could happen, the riskier the investment. Risk, in finance, is the price of not knowing the future. Section 3. Know your own risk. Here is something crucial that no formula can tell you. How you feel about risk is deeply personal. Investors fall, roughly, into two camps. On one side are the risk-averse, who feel the pain of a loss far more sharply than the joy of an equal gain, and who will gladly accept a lower return for a good night's sleep. On the other are the risk-tolerant, who can stomach big swings in pursuit of bigger long-run rewards. Neither is right or wrong. But investing smartly starts with honestly knowing which you are, because the best portfolio is not the one with the highest possible return. It is the one whose risk you can actually live with through the inevitable downturns, without panicking and selling at the worst possible moment. Section 4. Is 7% good? Now a question that will change how you read every investment return. Imagine your statement shows your portfolio returned 7% last year. Is that good? Your first reaction is, of course, 7% is positive, so yes. But in finance, a single number almost never tells the whole story. The real answer is, it depends, and that brings us to the most important word in performance, the benchmark. A benchmark is your yardstick, the answer to the question, compared to what? If your portfolio is all U.S. stocks, the benchmark is an index like the S&P 500. If that index returned 12% while you made 7%, then your 7% was actually a poor result. You underperformed. Good returns can hide bad performance. Section 5. Risk-adjusted performance. The benchmark is only half of judging performance, because we have not yet accounted for risk. Suppose two funds both earned 10%. One did it with a calm, steady portfolio, the other by making wild, volatile bets that could just as easily have lost a fortune. Are they equally good? Absolutely not. The second fund took far more risk for the same reward. This is the heart of finance. You must judge return relative to the risk taken to achieve it. A modest return earned safely can be a better result than a big return earned recklessly. This idea, return per unit of risk, is what professional performance metrics measure, and it is exactly where the next episode begins. Ignore risk, and you will be fooled again and again by big returns that were really just big gambles that happened to pay off. Accounting for risk is, in the end, the difference between investing and gambling. Section 6. Don't put all your eggs in one basket. Now to the idea that transformed investing. You already know the folk wisdom. Do not put all your eggs in one basket. Finance turned that proverb into a precise, powerful tool: diversification. The insight is this: when you hold many different investments, their ups and downs partly cancel out. On the day one stock tumbles, another may rise, so the value of the whole portfolio swings far less than any single holding. Crucially, you can reduce the overall risk of your portfolio without necessarily reducing its expected return. Diversification is the closest thing finance has to a free lunch, a way to make your money safer not by accepting lower returns, but simply by spreading your bets wisely across investments that do not all move together. Section 7. The Markowitz Model. This insight was made rigorous by Harry Markowitz, who won a Nobel Prize for it, founding what we call modern portfolio theory. Take the simplest case, a portfolio of just two assets. Markowitz showed that the risk of the combination depends not only on each asset's own volatility, but critically on their correlation, how they move in relation to each other. If two assets tend to move in opposite directions, combining them cancels out much of the risk. The magic is that the portfolio can end up less risky than either asset held alone. Plot every possible combination, and the best ones trace a curve called the efficient frontier, the set of portfolios offering the highest return for each level of risk. Smart investing means choosing a portfolio on that frontier. Section 8. Putting it together. So here is the complete picture that opens the finance track. Every investment trades return against risk, and risk is the uncertainty of outcomes, measured by volatility. How much risk to bear is a personal choice, so know yourself. Judge any return against a benchmark and against the risk taken to earn it, never in isolation. And above all, do not hold single bets when you can hold a portfolio, because diversification, as Markowitz proved, lets you cut risk without sacrificing return by combining assets that do not all move together. This is the mental framework of every serious investor and every fund manager. Everything else in finance, the metrics, the bonds, the stocks, the options, is built on top of this single foundation, the disciplined pursuit of return per unit of risk. Conclusion: we have laid the cornerstone of finance. Return always comes with risk, and risk is the uncertainty around your outcome, which we measure as volatility and which each of us tolerates differently. A return means nothing on its own. It must be judged against a benchmark and against the risk taken to achieve it. And the great breakthrough of modern portfolio theory is that diversification, combining assets that do not move in lockstep, can lower your risk without lowering your expected return, with the best portfolios lying on the efficient frontier. Carry this risk and return mindset into everything ahead. In the next episode, we turn the idea of return per unit of risk into precise tools, the Sharpe, Trainer, and Jensen measures that professionals use to grade performance. If this gave you a foundation, please subscribe to All About Economics and share it. See you there.